Hey everybody, welcome back to Dividend Stockpile. Today we're talking about all things energy, and I've got the perfect guest to help us break it down. I'm joined by Parag Sanghani, Senior Portfolio Manager and Senior Vice President over at Westwood ETFs. He's a portfolio manager behind two of the income-focused energy ETFs we're going to talk about today, WEEI, the Westwood Salient Enhanced Energy Income ETF, and MDST, the Westwood Salient Enhanced Midstream Income ETF. So today we're going to dig into what makes these two ETFs special, how they see the current energy income space, and what investors should keep in mind when they're looking at this part of the market. So Parag, thanks for coming on.
Yeah, thank you for having me, Jeremy.
Absolutely. Really looking forward to this. Energy is such a big part of most income investors' portfolios. And there's so many different dynamics to the energy market. I really wanted to get an expert on to talk about what all the different aspects of energy investing there can be, and what are some of the resources that are out there when it comes to the ETF landscape of how people can get invested in these particular industries. So with that, can you give a little bit of background on your company and yourself?
Yeah, absolutely. So I started investing in energy back in 2004. Started as a sell-side research analyst, and then in 2008, actually joined my partners who had just launched an energy investment firm and started investing predominantly in midstream companies and then broader energy over time. So we've been doing this for a long time together. Here in Houston, where we're in the center of the energy capital here. And so it's been a real good, interesting experience. What I can say is that if we look at more broadly what our team here in Westwood does, Westwood as a firm is value focused. And so we have strategies that really try to pull out companies that are good cash flow generators over time, across industries. And our team here in Houston, we manage about $2.5 billion in public energy assets, really trying to tease that out. Westwood manages about $17 billion overall.
That's great. Thank you for that background. So the two that we're going to talk about today is WEEI and MDST, two of your energy-focused income ETFs, which is a very unique approach. A lot of times you can get the energy exposure, but you don't necessarily get the high income, or you can get the high income, but they're focused on maybe tech names or something like that and for the option strategy. But you guys have chosen to combine the two. So can you give a high-level overview of both WEEI and MDST, and then we'll go into the details later?
Yeah, absolutely. So WEEI is large cap focused. So we own larger companies across the oil and gas value chain. So if we think of what the industry is in energy, energy is very large. There are chemical plants, utilities, refineries, etc. What we're focusing on specifically in WEEI is that oil and gas supply chain. So it's the producers, the rig companies that help the producers produce the oil out of the ground, the pipeline companies that transport that oil and natural gas to the refineries or the end users, and then the refineries themselves. So it's a value chain investment opportunity across the oil and gas industry. What's exciting about owning broad oil and gas is that we generate, as an industry, it's high income and high yield without any kind of option overlay. So you're getting north of a 3% yield just owning broad energy companies. And then when you tack on top of it the yield that's generated from selling options, we can actually generate quite a bit of income overall. With WEI, we are distributing about a 12.5% yield today. Of course, that can fluctuate depending on option income over time. But we think that given the volatility historically that energy has exhibited, option premiums tend to be a little bit higher. That allows us to capture more income over time. In terms of MDST, MDST focuses specifically on midstream. And the reason we like midstream is really two main reasons. One, midstream has a lot less commodity exposure. So when we think of oil prices fluctuating as high as 80 earlier this year, down to below 60 today, that gives a lot of cash flow exposure to companies that produce the oil. But for a pipeline company, they're going to receive $1 a barrel to transport it from West Texas to Houston, regardless of if oil is at 80 or at 60.
Yep.
And so that cash flow tends to be a lot more consistent over full cycles. And for that reason, what we've seen historically is that midstream companies actually pay more to investors as dividends.
hmm
So today, the industry pays north of 5%. And then when you tack on top of that options, today we can generate right around 5% a year in option premium for a double digit uh, total income generation. Now, what we actually see in practice is depending on time periods, like in April when there was a little bit higher volatility, options premiums had gone up. And so we were generating a little bit more there. In times of calm, we generate a little bit less, but over time, it's averaged right around that level. And so today, MDST pays 22.5 cents on a monthly basis as well. And that translates to just north of a 10% yield today.
Yeah. It's really great to have exposure to these industries, which most dividend investors, income investors, at least have some exposure to already. But getting that added extra options income on top of it really helps, one, increase the income you can provide, and also smooths out the ride a little bit more. So you're continuing to get that income no matter what the volatility of the market gives you. And energy markets in general are pretty volatile. There's a lot of factors that go into, especially in the oil and gas space. Interest rates, this energy cycles, regulations. There's so many things that can go into it. So having that stable cash flow from the options and actually taking advantage of the volatility in those options actually helps when it comes to total income. So I guess with that, how do the macro factors of the economy and the global oil market affect like how you choose individual stocks or how much exposure you have to certain sectors? How do you guys look at that?
Yeah, absolutely. So when we think of the opportunity set, great news is the global economy is growing. And when the global economy grows, the demand for energy grows. And there's a lot of talk of energy transition. There's a lot of talk of alternative fuels. The reality is the need for energy is so great globally that it is an all of the above solution.
Mm-hmm.
And demand for oil and gas continues to grow globally at a very healthy rate, but it's not growing like a tech stock, right? It's growing 2 to 4% a year, very steady over time. Depending on the type of commodity, natural gas demand grows a little bit faster, oil demand grows a little bit slower. But when we look at the total amount of demand, that grows right around that 2 to 4% per year. And that is what really drives the industry. So over time, volumes increase, and the opportunity is to own the companies that are delivering those volumes at economical prices.
Mm-hmm.
And so today, fortunately for us, the United States is the powerhouse producer of oil and natural gas. We produce 20 million barrels a day of total liquids. That's oil plus natural gas liquids combined. We produce quite literally almost 20% of global supply in liquids. If we look at natural gas, we produce 120 billion cubic feet a day of natural gas now, today.
Mm-hmm.
That number was about 15% lower just a few years ago. So as the United States grows those volumes, what we're doing is we're exporting those volumes.
Mm-hmm.
What I'm getting at is we've got a lot of resource. That resource needs to get to market. And once it gets to the export facilities, it needs to be able to get loaded onto ships and sent out to our trading partners throughout the world, in Europe and East Asia. And so that infrastructure, in our opinion, is probably the single best place to be invested over the next 5 to 10 years.
Mm-hmm.
But when we look at the whole value chain today, energy is out of favor.
Mm-hmm.
And when you've got an out of favor asset class that's trading at a small discount, not a huge discount, but a small discount versus 10-year averages, that's a great opportunity versus a broad market that's trading at historically high valuations, where there's a lot of things that are expect it to go right for the market to continue to work. And so we think that it's not an either or. It is definitely, you want a little bit of exposure to energy in your portfolio, helps you round out your exposures. And in the meantime, you can also increase your income by owning an MDST, which is less commodity sensitive, or a WEI that is a little bit more commodity sensitive, depending on your angle and what you see as the opportunity today.
Yeah, it gives a great alternative to just your typical energy companies or energy ETFs. This one allows you to have that added income while still getting the exposure. So let's talk about some of the holdings. I know we're not going to go into the details, but for WEEI, we have things like ExxonMobil, Chevron, ConocoPhillips, looks like Valero, Phillips 66, all the big oil producers that everyone's pretty familiar with and might already have in their portfolio. And for MDST, you have companies like Enbridge, Energy Transfer, Williams Company, Enterprise Product Partners, and DT Midstream are some of the top ones. So it's very typical for those industries. You guys are holding the major players, like which was to be expected. But then to your point earlier, you're able to generate additional income from the options premium you can get on these particular companies. So can we talk a little bit about the option strategy on each of these funds real fast?
Sure. So a lot of ETFs out there actually have option strategies. When we launched the energy focused strategies, we realized that there's quite a bit of white space in the industry where a lot of the strategies that existed focused on index level options, focused on writing maybe quarterly or even 6 months out into the future. And it made a lot of sense to do that. The reason it makes a lot of sense to do that is it requires a lot less work.
Yeah.
But the reality is, in the options market, premiums come from three main sources. One is volatility.
Mm-hmm.
Second is how far out into the future an option is written. And then the third is the strike price. How close to the actual stock price today is that option written? When you write an index option, you're writing an option on a group of stocks. When you write an option the way we do, we write it on individual companies. What that does is, generally speaking, it's not always the case, but generally speaking, a single stock option will have higher volatility than an index.
Yep.
Depending on the time period, the shorter options chained over a multiple month period. So let's say I write an option for this month, then next month, and then the third month out. Those three options combined would make more money than a single index option a quarter out.
Yep.
So you get that benefit of the monthly option roll. And then on top of all of that, you can choose a strike price per stock.
Yep.
And what that does is we have fundamental research here in our office, our team together. We have outlooks on individual companies. We have price targets on individual companies. And so we're able to tailor each option that we write to what we believe the fair value of these companies should be, capturing as much upside and income as we can triangulate in the process. And so we think that that mousetrap should over time give a better option result than just doing a blind index oriented strategy.
Yeah, having that flexibility to pick and choose which stocks you want to do it on, and the amount of the out of the moneyness that you choose goes a long way of keeping the NAV going up. You know, your capital appreciation going up, but also giving you a consistent high income. So it's a good combination. I love the fact that you guys are able to do on individual stocks as opposed to the index. So that definitely makes a huge difference. And you're also doing a little bit out of the money, so you still have that upside potential. A lot of these other ETFs out there do it right out the money, or like 1% out of the money. You don't get to capture all the upside. And so having that flexibility goes a long way. When you're doing your option strategy, do you do it on 100% of the portfolio? Is it a mix? How do you approach that?
Yeah, so we're not required to write the options, which is good news. A lot of programs are literally just programs.
Yep.
What we're doing is we target 95% overwritten, so we're trying to stay predominantly overwritten. But for example, in April, prices came down sharply. We waited. We waited. We figured a 10% down move in a week is aggressive, and so we waited. We didn't wait long, but we waited a few days before we initiated additional options. And so we have that flexibility. The other thing is also the strike price that we can write. On average, we're usually about 5 to 9% out of the money.
Okay.
And it of course varies depending on the volatility, depending on the market environment. So when volatility spikes, we're actually able to go further out and still generate the income that we're trying to target.
Yeah.
And so that allows us quite a bit of flexibility there as well. So being 95% covered, we've done the math on this, and it does vary. Last year, MDST captured right around 60% of the upside. This year, MDST is actually capturing just about all of the upside. And it's because this year has been more of a flattish year, whereas last year was a significant price appreciation year. So, we think you're going to get, on average, closer to that 60 to 70 than you are the 100%. But we're going to participate on the upside month in and month out. And that's what's exciting as well. It's not getting capped right where you are.
Exactly, having that capital appreciation, even if it's not 100%, but also trading that extra upside for that immediate income is a huge benefit to a lot of investors, especially those who are focused on the income side of things. You don't want your account value to go down, but you still want to get that income. It seems like a pretty good balance. Now, a lot of investors who are looking at these income-focused ETFs or options-focused ETFs are concerned about the tax implications of writing the options. So what kind of tax strategies do you guys employ on these ETFs to help out on that side?
So we are not tax experts, so please talk to your tax advisor. In terms of the distribution that we provide, it comes back in three forms. It comes back partially as a qualified dividend income, partially as ordinary income, and then partially as return of capital.
Yep.
And so from a taxable standpoint, return of capital gives you some of that tax benefit. But the percentages, unfortunately, we cannot know in advance. It fluctuates year by year, depending on distribution. So far, year to date, my understanding is that the majority of the distribution has been classified as return of capital. But again, that fluctuates, and it could be 100% QDI, or it could be 100% ordinary also. But we think that over time, it'll average out to those three buckets.
Yeah, that makes sense. And now, one thing that I've noticed, a lot of energy-related ETFs have a K1, and a lot of people are a little scared off on that. Can you explain how you guys operate with that?
Yeah, it's great news is the ETF structure that we employ is a 1099.
Nice.
And so you don't have to worry about K1s. In the case of MDST, we do own K1 securities within the ETF. However, because it's in the ETF wrapper, investors will receive a 1099.
That's great. Okay. So see, the energy market can be pretty volatile. We've seen spikes and dips pretty regularly. What do you guys use when it comes to risk management inside of your portfolio to help mitigate some of those swings that you see sometimes?
Yeah, it's I think the approach that we take is a little bit different than some other investors in this industry. My background in sell-side research, I actually ran supply-demand models. And what we first and foremost focus on is what is the balance of supply and demand. And we have to break it down into three separate commodities. It's oil, it's natural gas, and it's natural gas liquids. What's really exciting today is natural gas. When we look at the build out of AI infrastructure, that means that we need a lot more power. A lot more power means that we need always on power plants, and always on power plants, unfortunately, is not solar. While we'd love for solar to take over the world, the sun only shines half the time. So the reality is today, what we've seen is the vast majority, over 80% of the announced power plants that we are aware of, are being fueled by natural gas. And so the demand for natural gas is accelerating as we look forward over the next few years through the end of the decade. And at the same time, that resource is being pulled into the LNG market. So Europe is trying to buy more US LNG, less Russian LNG. East Asia is trying to buy more US LNG. So there's a global market for our natural gas. We know that demand is growing very rapidly. We expect supply to keep up at a healthy price, right? You don't get supply if prices are low.
Hmm.
So we think that prices will be at a healthy level, and that supply will grow to fill all of that demand, and that's going to require more volume. That's going to require more infrastructure. So when we look at the risks, we see positive risks that we're likely to exceed expectations on natural gas demand, or I should say more likely than less likely. So we're excited about that opportunity, and we overweight that side of the portfolio across both WE and MDST. On the oil side, oil markets are oversupplied. We've seen OPEC increase production this year. By our math, we are several million barrels a day, maybe 3 million. It's hard to really gauge it in real time, but it's a significant number. And it will take time for demand to catch up to that supply. In all honesty, we expect OPEC to eventually cut production again to balance the market. And so we're a little bit less excited about the oil exposure. And so we've taken a little bit of that oil directed pipeline capacity or production and moved it more towards natural gas producers and natural gas pipelines. And that's kind of how we've mitigated some of that commodity risk that we see near term.
Hmm.
Aside from that, we also, the biggest risk I think in the portfolio really is opportunity cost, right?
Okay.
A lot of investors think, oh, I'm getting great income, but there's a cost associated with that income, and that is that we are giving up the upside.
Hmm.
If there's a spike in oil prices to $120 a barrel, like we saw in 2022, we will not capture that, right? It will capture only a portion of that
Hmm.
opportunity. And so there is a cost associated with that, and it is definitely an opportunity cost, which is why I talk about that 60 to 70% is what we hope to see as a consistent amount that we capture on the upside. The good news, though, is having that high option income does provide a little bit of cushion
Hmm.
in a price correction.
Yep.
So we've seen, over and over again, particularly in that drawdowns that we've had in the last year and a half, those drawdowns haven't been met with 100% drawdown on the the net asset value or total return. And
Hmm.
so that we see is acting exactly how we expected.
So let's talk a little bit more about the ETFs. Again, we're talking about WEEI and MDST. How long have they been around, and what are the management fees associated with it? Anything else you want to talk about when it comes to like more of the logistics of the funds?
Sure. So the ETFs themselves were launched in spring of last year. So MDST was April of 2024, and we was in May of 2024.
Okay.
And then in terms of fee structure, uh, we've got about 80 to 85 basis points, depending on which one you're looking at. So it's very well, very competitively priced versus other products out there in the marketplace.
Yep.
Uh, and then, when we look at it from just where does this belong? And I think this is important. Uh, we thought that we and MDST would just be another tool in a toolkit. We've always been total return investors, and a lot of clients have historically asked us for more income-oriented products.
Hmm.
And so it made a lot of sense to create a strategy that we thought captures a lot of the opportunity and generates that income. What we found was really interesting is that we've had clients actually tell us that, oh, it's great that I'm taking a little piece of my equity portfolio, putting a little bit into MDST, generating more income from my equities. What that's allowing me to do is own less risky debt. And I was like, oh, that was not that was not something that we were expecting. So yeah, there's a lot of interest in private credit, for example, today, and there's a lot of risk associated with that. What's the right exposure for that? We don't know. But what we could do is, if you feel you're overexposed there, just to grab a 10% type yield, here's another opportunity. Yes, it's equity risk, right? But it generates the income and allows you to manage your portfolio in more ways than you were able to do previously. And so I think that opportunity of really shifting across multiple buckets is really the unique thing that the ETFs really provide. And the best part is you don't own the over concentrated names in the broad indices. And that's the best part about it. It's a true diversification tool for most portfolios.
Yeah, I love it. And the fact that you guys are actively managing, picking the individual securities, picking the individual options, it's a much better approach, in my opinion, at least, than just an index-based or sector-wide exposure that some of these other ETFs give you, because you guys are actually looking at the fundamentals of the companies as opposed to just picking them all. So I think it's a great package you guys have put together, both in WEI and MDST. So with that, where can people find more information about these funds, your company? Are you guys on any kind of social media? How can people reach out to you?
Yeah, for anyone looking for more information, you can go to westwoodgroup.com. We've got quite a few ETFs listed there, as well as our other products. And then you can also reach out to a Westwood representative.
Awesome. Really appreciate all the information that you're able to provide, both on MDST and WEI. Parag, really appreciate your time. Thanks for coming on, and hopefully we'll be able to chat soon.
Yep. Thank you very much, Jeremy.
Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.